Hello team, welcome to another video with the Manga Method. We're going to spend today looking at business activity statements. So this is something that's specific to Australia. Other countries will have a similar mechanism, not likely to have the same name. But in Australia we have business activity statements or installment activity statements as well. So those are the interim ones if you're on a quarterly statement. The main point here is these business activity statements are used as self-reporting mechanisms for us to self-report to the tax office. And it covers things like pay-as-you-go withholding, so your withholding of employee taxes that as a company you've withheld on behalf of your employees and paid to the tax office. We'd also be dealing with the net calculation of GST collected and paid, and then having the net amount worked out to either be paid to the tax office or a refund to be collected from the tax office. Finally, if there's installments for company tax that you might need to pay, if companies that are profitable, the tax office also wants to take its installments during the year as well. So we're going to look at BAS in a very specific context. It's BAS where you have a quarterly BAS, so done on the quarter ends, so March, June, September, and December. We're going to look at the ones that are done by a bookkeeper or a BAS agent that lodges on the company's behalf. It's actually very common in the general business landscape. I saw it time and time again as a banker, and time and time again now as a model builder, where we've come across businesses that have these agents that do the lodgements on behalf, and they'll do it once a quarter. With the BAS agents, you're afforded an extra month on top of the quarter end. So usually if you had quarterly reporting, your lodgement and payment will be due at the end of the quarter plus one. So if you were June, for example, you would be due to make a payment in July. Whereas when you lodge through an agent, you get until August to lodge and pay. Let's have a look at that in our global section. So we've got these payment cycles. So looking at the months Jan through to December, we look down at the BAS quarter agent profile in particular, and we see Jan, Feb, March has a 5 or a May reference. April, May, June has an 8 or an August reference, and so on and so forth. October, November, December has a February reference, and we know that we have an article there, which we can link you to, but the article talks about why February is quite a scary month. Now, the topic and the discussion is actually exactly the same. The mechanisms that drive the scariness are actually very similar. The added pain in Feb is that Jan and December tend to be somewhat low trade months, so just something to be quite aware of. The year focuses on the August payment, so the April, May, June trading activity, which is due for lodgement in August. Yeah, let's delve into it. So this is our trustee core financial model. We've got a business here just forecast out, and we're purely looking at the period in question. This business on average is turning over $1 million. It is also on average, it employs the equivalent of 50,000 a month, or 60,000 plus the 12% for super, and it's got about 200,000 worth per annum, 200,000 worth of expenses for a year. And that leaves the business with about 7.6% in EBITDA. Now, that's not the best, but it's actually not uncommon from what I've seen in a lot of businesses, unfortunately, in this day and age. But let's run with this. If we look at the balance sheet, so we've got our balance sheet cash growing. We haven't got accounts receivables and we haven't got accounts payable. So let's just turn those on, because those are important factors here as well. So if we open our model and we look for our accounts receivables, our profile's standard for 30 days. We do have that profile there. We just need to make sure that account is allocated to accounts receivables, and if we've got our accounts, our expenses, we need to make sure that that's allocated to accounts payables, just so we have notionally some figures there. So yeah, okay. So if we're looking at this scenario, and we've come in from August, we've come in from May, and we've gotten into June. June is interesting because it's often the period where people are doing their year-end tax planning. They're thinking about, okay, well, we made a bit of profit in the year. How much cash do we have? And a lot of businesses, a lot of these small businesses that we work with, run their business by their bank account. And that actually probably is the biggest concept of running a business that creates these problems, where you look at your bank account, collected a bit of cash, you've paid the last BAS that was due in May, you've collected a bit of cash from May's trading and maybe some from June and some of the leftover from April. You've got a bit of cash and you think, okay, cool, we've got a bit of profit in here. We need to go and pay out some funds, either through expenses or management expenses. It's just, the point is some profit left over that you're looking to unwind, invest in new capex, so on, just to make efficient your tax position for the next year. Now, 37 looks great. Great, but 37, at least you have a positive balance, which is great. Now, what we're going to do is, in a lot of these cases, what I've seen is businesses go, oh, 37,000, well, we need to get rid of that. And what happens is they'll go and buy some equipment or machines where they go, okay, well, 37,000, let's go and buy ourselves some equipment to bring that number down in June. Now we've got ourselves at 30,000. 30,000 in spend brings us down to 4.8, keeping the cash balance tight and low. And then what we find is July we have a pickup, but then in August, all of a sudden our cash drops down. Now this isn't factoring in any director drawings that might be occurring, which don't relate. And like the capex, we didn't see that P&L impact. So sometimes people they're not looking at it, they don't see it, and they don't pick up the cash flow impact of doing such a thing. And so yeah, if we look at the balance sheet as at June, just to dissect this a little bit, we've got our accounts payable, accounts receivables, these are all flatlined. Now in reality, things are moving up and down a lot more, which actually complicates it even further. This is a very stylized and simplified example, but with further complication, it actually makes it more important to look into it deeper. So what we'll see is there's a build-up of pay-as-you-go withholding, so 12.5, 25, 37.5, 50. We've notionally done it as 25% of the base salary, and then you'll see that this figure then drops down significantly in April to about 25,000. Super is paid in July, so we don't have the effect there. But now what we also see is GST payable that is brought down comes down in August as well. So there's a couple of big movers in here, and this is also assuming that company tax hasn't been requested to be paid as installments, because theoretically in a year, if we've made, let's call it 19,000 times 4, let's just round that up, get it to about 80,000, 25. So that would get to about 20 grand in taxes payable. Then what we're looking at is all of a sudden our cash position in August is now not only just 10,000, but potentially with the company taxes payable and any drawings, if the director's drawn funds in July thinking, hey, we still have some cash, then all of a sudden we get to August, we do our lodgement, and all of a sudden we realize we don't have a lot of cash to play with. And time again, this is what would happen, and we would have businesses come to us and go, hey, we need a payment plan, or we need an overdraft. We need to overdraw our account so we can make the BAS payment, or we can make payroll, whichever's come first. Often payroll has occurred first, and BAS lodgement occurs right at the end of the month, where people realize and they go, oh, we don't have enough for BAS. So, a couple of potential solutions. First, if you can top up the the company with some cash flow, that would be ideal. If you pre-plan, that actually would be even more ideal. So if, in June, we've actually gone and forecasted out the cash for the next few months and gone, okay, hey guys, there's actually a bit of a dip here. We need to factor that in managing our cash flows. Maybe build a cash reserve. Ideally, the downside of having these pay-as-you-go withholding is that you get a sense or an oversized sense of what your cash balance looks like because of these liabilities that you haven't paid yet. So that's when I say there's the danger of running a business by your bank account. That is time and time again something we see. And it's just easy for business owners to do that because they look at their bank account, they're like, we've got enough cash. The business is making profit. Easy days. We don't need to worry about it. I can draw the money. I can spend it, whatever. But lo and behold, there's capex that they didn't think about that they've made. There's pay-as-you-go withholding that they need to pay. There's super that needs to come out. There's GST payable. All of these balance sheet items that they weren't really thinking about, it's kind of in August come back to bite them. So yeah, if you can get in early with the forecast, that will really help you to assess how much you can actually withdraw. And maybe you don't spend the 30, maybe it's 10, or maybe you fund it a bit. So that 30 grand is funded at the time of purchase, rather than paid out of cash in this example. A final example is, yes, you could approach the tax office and request a payment plan. Now, this is something, especially as we head into 2025, that's going to be a lot less popular or not as advised because the tax office is now not allowing for deductions in the interest or general interest charges it makes on any funds lent. Now, for short term, if this is purely a short-term thing, maybe there's the option to extend the payment plan for a short-term cycle, which sometimes doesn't attract that interest, and it makes it beneficial from a cash flow perspective. Will asking the tax office for, if we try and keep it short, so let's say 3 to 6 months as a payment plan, there is the possibility that there's, and also depending on the amount, there is the possibility that a payment plan does not attract interest. One other option is to speak with your financier and potentially seek an overdraft. That might be a relatively cheaper option, especially if you're early on it. And if we come back to the ATO example, if we do request an ATO payment plan, the option there is we want to be careful, like using something like that. I have seen that go quite wrong for businesses as a banker, where we've had to garnish cash because they haven't made payments. We need to make sure that if we do go into a payment plan that's 3 to 6 months or 12 or any longer period, we really need to make sure that the business is generating profit so that it can earn sufficient profit to eventually pay down that debt. This is new debt that you're creating. And on top of it, we need to also make sure that we're managing our cash flow cycles in future so that, one, we can pay off this debt, but two, we can also make payments on any future obligations that will come up, because this quarter will repeat itself again in November, in February, in May, so forth. So if we don't correct it here, it just sort of gets worse and worse over time. It's crucial that the first thing we always do is we need to assess the profitability of the business, because without profit, it's kind of a moot point. You just borrowing money just to pay back debt, which in the long run will just lead to disaster. So let's quickly identify that there's profit generation, then managing and planning the cash flow and requesting that payment plan, knowing that in subsequent periods profit will be generated and there will be sufficient profit to pay back these obligations as they build up again into the next reporting cycle. So crucial thing to note, and we'll probably repeat this message again in November or December, with an example that leads into February, with potentially, looking at the seasonality that occurs in December and Jan. But, giving you some thoughts about looking ahead, planning for cash crunch periods. And these cash crunch periods are so common that it's definitely worth addressing in your business and making sure that you have the forecasting set aside for this. We might drill into this a bit deeper in another video, maybe specifically how to forecast this particular example, or forecast examples. But if you have questions, obviously feel free to reach out to the team and reach out to myself. I'm happy to kind of give you some thoughts around, okay, what are the key things to think about with these cash flow cycles? And give you some hints on how you can build that into your cash flow or your just general governance and financial control processes. Well, hopefully that was useful for you, and hopefully you've taken something from this video. Give us a like, a subscribe if you enjoyed the content and you're looking for more. Throw a comment down below if you've got some thoughts, feedbacks, or queries, or things that you want, or scenarios that you want us to run through on the analysis side, as well as how to model the specific scenario out. All right, well, thanks everyone, and until next time.